However, it may not pertain to you because your situation might be very different from what I am going to be presenting today. So in order for you to take any kind of tax position on your tax return, you must have a written statement from me, basically letting you know that, yes, based on your personal circumstance, you may use this tax strategy specifically designed for you with your own circumstance in mind, okay? All right, so here's a reality, ladies and gentlemen. It is not what you earn, but what you keep that's important. What do I mean by that? Well, in order for you to keep more of what you make, you got to do some tax planning. And in order for you to do tax planning, you have to think ahead. As in, right now, we're in 2020. You want to be thinking about how much in taxes you can actually manage and what kind of tax rate you want to hit by the end of 2020. And it's very normal because big corporations and wealthy people, they do that all the time. So you're asking yourself, well, like, how do they do it? The way they do it is by hiring their tax lawyers, their tax CPAs, and this team of people do all sorts of calculations, and that's how they do it, okay? Now, for middle-class families, it would be tough for you because you may, number one, may not know that there's such a thing as tax planning, and then number two, it's going to cost you money to do so, right? And so the purpose of us in Champ here for the past, 6 weeks or so, to have this weekly webinar is to share with you what you can do, and then to the extent that you feel that it's feasible, in other words, the cost and the benefit makes sense for you and your personal situation, then you can hire me as your personal tax CPA. I'm going to be looking at your personal tax situation and your overall financial situation, and then I'm going to put together a plan for you, okay? So what's the difference between tax reporting versus tax planning? Well, tax reporting is what you do by April 15th every year. Well, for this year, 2020, it's going to be a little bit different because of the COVID-19. You're going to be having an extra 3 months to file your taxes. So you have until July 15th this year, 2020, to file your 2019 taxes, okay? So what you do every year is that you report to the government what has happened the year before. So I call this a reactive mode, kind of doing taxes. And then, of course, there's something called tax planning. Now, tax planning is an act of intentionally causing the situations and circumstances to change to fit into the tax laws so that you stay within the boundary of the tax laws, yet you minimize your tax liability. And I call that a proactive mode. You proactively manage your tax situation so that you still stay within the laws, the tax laws. You're not breaking the laws, and at the same time, you're cutting down your tax liability. So just like financial planning, okay? Tax planning also needs time and different strategies depending on your personal situation. So if you look at this picture right here, so every day you wake up and you go to work, you make money, okay? And when you make money, your money has to go somewhere, right? It could go to the bank, it could go to your retirement account, it could go to pay your bills, it could go to your real estate investment properties, what have you, cryptocurrency, et cetera, et cetera. So this bucket here represents your wealth, your family wealth, okay? So as you can see, in addition to taxes, you got to be very mindful of the following risks. Number one is market risk. Number two is the kind of return you're getting on your money, okay? Rate of return, quite important. And then the amount of interest that you're paying the bank. Now, most people have a mortgage, right? Okay, so are you thinking about how much interest that goes to the bank, not only in your current generation, your present generation, but also the generations after that and multi-generations after that, okay? Most people do not know that this piece right here, the interest piece, actually impacts this bucket right here, their wealth bucket. And I'm gonna go into that in subsequent webinars, okay? Opportunity cost. Now, if you've never heard of this term before, opportunity cost is a cost that you don't see. In other words, let's just say if you put money in that stock market, and if the stock market goes down, well, guess what? You now lose an opportunity to make money, say, in a savings account, even though it pays you 0.01%, okay, which is ridiculous. But guess what? You just lost an opportunity to make 0.01% because you just lost money on the stock side, okay? So that should also be considered in or as part of your wealth building strategy. And then, of course, debt. A lot of people have to pay a lot of money to banks to carry on debt. We have good debt and we have bad debt, okay? Is it okay for you to have a mortgage debt? Well, it depends, okay? Let's say if you have a mortgage on which you pay 2% interest rate, and you use the money, you have cash, but you could pay off your mortgage debt, but you don't want to. What you do is you take that cash and you go invest somewhere else that would pay you 9% interest, okay? And it's a guaranteed interest, okay? And so every year you make 9% interest, and then on this side, you pay the bank 2% in interest. And therefore, should you have a mortgage at all? Absolutely. Why? Because you get your money over here making 9%, and then you pay the bank only 2%. And so even after you deduct the 2% mortgage interest that you pay to the bank, you still have a gain before tax of 7%. I call that the spread, right? So definitely in that situation, you should have a mortgage debt, right? Now, a lot of people, they want to pay off their property loan, you know, what have you, because they want to have a peace of mind, okay? So they're sitting on an equity that's worth a lot of money, and then at the same time, they would have their cash money making 0.01% at the bank. You know what I'm saying? So that's not planning because, it's not planning because you're paying the bank 2%, but then your money is only making 0.01%. Does it make sense to you? So that's not planning, okay? Inflation is another culprit here that most people don't pay attention to. I know a lot of Asians, we tend to hide money under our pillows. Okay, or maybe in the yard, you know. I know people would just like dig a hole in the backyard. That's where they keep their money. Well, inflation runs about 3 to 4%, depending on who you ask. You know, CPI, Consumer Price Index, could go as high as 6 or 7%. So if your money is not making at least 6 or 7% per year, then your money is losing value. Make sense to everybody? Because of inflation right here, okay? And so not only in this seminar or this webinar, every week we talk about just taxes. Tax planning is great, but I believe that if you want to be super financially independent, not only in your generation, but in many other generations, right, after yours, you gotta think about all this. And then last but not least is long-term care, because long-term care costs a lot of money. And a lot of people just don't know how to deal with that risk. So I'm going to be talking about that as well in subsequent tax webinars, okay? So So here's the talk start. So what's the basic framework of tax planning? When people talk about tax planning, or when Susanna talks about tax planning, what is she talking about? There are 4 different steps in tax planning. Number 1, you want to minimize or you want to reduce your gross income into certain forms of income that can be excluded from your gross income. Make sense to you? Okay, and we're going to go into that later. Number 2, you want to arrange your activities in a way that would turn your personal expenditures into business deductions. Make sense, everybody? Number 3, you want to take advantage of special tax credits against your final tax liability. And there are just a lot of special credits out there for different types of taxpayers. And lastly, you want to use the progressivity of the tax rate structure through the allocation of your family income. So for a family of 4, husband, wife, 2 kids, if the husband and the wife are in a higher tax bracket and their little kids are in a lower tax bracket, there are some planning that we can do there to shift the parents' income to the kids because the kids is on a different tax bracket. Okay, so these are the 4 basic framework of tax planning. So to further demonstrate what this means, I'm going to share with you one of my favorite TV shows back in the 90s, Earth Rock from the Sun. I don't know how many of you have seen that show before, but in episode something some years back, all right, so a little bit of background. So Earth Rock from the Sun is a TV show about aliens from outer space who would come to Earth, and they live inside the bodies of humans, okay, in the form of a family. So Dick is the main character who is the dad, and there are some siblings, a sister, a younger brother, and a son. They're all aliens, okay? And because they are aliens, they don't know that when they live on Earth, they need to pay tax. So this is an episode when he finds out he has to pay tax. And he and his family start to implement certain tax planning strategies to reduce their tax liabilities, okay? So Tina's gonna show you a clip. I think it will last about 3 to 4 minutes or so. It's really funny, but like keep that in mind, okay? What they do in this episode is that they try to do all 4 here. Number 1, reduce their gross income. And then they also arrange their activities in a way that would turn their personal expenses into business expenses. And then I'm not sure if they did any kind of credits, but you know, their refund was like huge. So I'm pretty sure they must have used some sort of credits. And then number 4 is the progressivity. Do you guys have a good laugh? That show is funny. All right, so Dick, unbeknownst to him, he didn't know about taxes, right? So he started taking home office deduction. He started to run a hair salon business. Sally, his sister, runs a hair salon business at home. And he also has a sign that says Sally's real business. That is hilarious. Well, that's not how you do tax planning to begin with, okay? So this is our family. Oh, by the way, it's very important that I showed you this. So we have 3 children, okay? And we make them work. And why do we make them work? Well, there are several reasons why we make them work. Number 1, because it will boost up their resume. Imagine when you have to apply for college and you show the school that you start working when you're 5 years old, okay? I mean, by the time you're 16, you will have had 10 years of working experience on your resume. That's pretty cool, in my opinion. But secondly, which I'm going to get into a little bit later, there are tax benefits for hiring your children to work for you. And it really doesn't matter how many hours in a week they work for you. As long as they work for you, you can pay them as though they are your employee, okay? So the tax game is quite complicated. As you can see, by 2015, there are over 10 million words in the tax code. I mean, that are a lot of words, as you can see. Now, just step back and look at this picture. The red line represents your capital gain tax rate, and then the blue line represents your personal income tax rate. As you can see, over the last 20 years, or not 20 years, 100 years or so, from 1906 until 2006, and now it's 2020, over 100 years, okay, the capital gain tax rate has always been lower than that for the income tax rate. And that's the reason why you have heard this all the time in the mainstream media, that Warren Buffett actually pays less in taxes in terms of tax rate that he's paying compared to his secretary. And the reason is because of this. If most of your income is by getting capital gain tax or capital gain, your tax rate will always be lower than somebody who's working as an employee getting a W-2, you see? And right now, we're in 2020. I mean, this continues. Capital gain tax rate has always been lower than that for personal W-2 income tax rate, okay? So now if you decide, okay, what is my main source of income? Is it gonna be ordinary income, or is it going to be capital gain? I mean, obviously, from a tax planning standpoint, you wanna move your assets so that more of your income actually comes from your capital gain tax basket and not your W-2 income, okay? Now, this picture here shows you the marginal tax rate in the United States for the past 100 years or so, okay? So the blue line, again, is the top marginal tax rate for people who have lots of income. And then the green line here represents the lowest marginal tax rate. So the poorest in the country, people who make very little money, okay? So as you can see, it has been very much been kept steady around 10% for the past 20, 15, 16 years or so. Back in the 70s here, it was almost at a zero. But for the past almost 2 decades or so, it's hovering around 10%, okay? So now, do you think with this COVID-19 and this huge stimulus package that was just passed a month ago, stimulus 3.5, and then the stimulus before that, not to mention the stimulus that we got back in 2008 when we had that dip in our economy. Do you think the tax rates are gonna go up or down 10 years from now, 20 years from now? It doesn't matter which party is gonna occupy the White House or in Congress, but do you think from a macroeconomic standpoint, when a country has to spend a lot of money like that, how is it going to balance the budget? And if you don't know, I would really like to suggest that you go to the whitehouse.gov website and really look at the country's budget, because the government actually does this every single year. It has its own budget, okay? And it knows exactly where the revenues or future revenues are gonna come from. And it's very interesting, okay? So we don't have a crystal ball. We don't know what's gonna happen in the future, but this is where it has been. So as you can see, at some point in our tax timeline here, the highest marginal tax rate was almost at 100%. 95% right here, right after World War II. okay? And then since then, it has gone down quite a bit. And right now, it's about 40% since the 90s or so. So we don't know if it's going to go up or it's going to go down, but it used to go up this high back then, okay? When the country really needed tax revenue to finance what? World War II, right? After World War II, it pretty much stayed this high. And then even the lowest tax bracket, all of a sudden,